You're now listening to the Tax Smart REI Podcast, the number one tax podcast for real estate investors. Thanks for tuning into this week's episode of the Tax Smart REI Podcast. Today, we're going to be talking about bookkeeping and audit defense. See, the thing is, bookkeeping is not the most exciting topic to talk about. It's not as exciting as reps or short-term rentals or selling a property tax efficiently or building wealth through real estate. However, bookkeeping is the foundation of the financials of your business. It helps you understand how to make better financial decisions, helps you get loans from the bank, helps make sure you're capturing all your tax deductions, and it might just save you in the event of an audit. So we're going to be diving into all of that in just 1 minute. Hey, Tax Smart investors, I'd like to invite you to join the 2025 Tax and Legal Summit presented by Hall CPA, taking place September 12th through the 14th, 2025. This free 3-day virtual event is designed specifically for real estate investors who are building long-term tax-efficient wealth. Over the 3 days, you'll hear from leading experts in tax, legal, and real estate strategy. Sessions will cover key topics including how to navigate the current real estate market, structure your entities for legal protection, understand the impact of the 2025 tax bill, avoid common tax scams, and preserve generational wealth. You'll also learn what's changed with IRS audits this year, how to avoid the biggest legal mistakes real estate investors make, and how to efficiently find and fund your next deal. General admission is completely free, but for those who want to take it a step further, VIP tickets are available for just $77. As a VIP, you'll gain access to exclusive bonus sessions, including a private legal Q&A with a real estate attorney, a one-on-one laser session with our tax strategist, and much more. You'll also enjoy priority access and extended replays of select sessions. This is a must-attend event for the year if you're a real estate investor who looks to minimize taxes, protect your assets, and build real lasting wealth. Reserve your ticket for free or grab your VIP pass for just $77 to access the full experience by visiting www.taxandlegalsummit.com/registration. Again, grab your free tickets or reserve your VIP tickets by visiting www.taxandlegalsummit.com/registration today. We'll see you there, but for now, right back into today's episode.
Yeah, absolutely. And thanks for having me on again. So the first thing to just kind of like outline here is, and we don't need to like go get super inundated with like tax jargon and stuff on this. I'll mention like a few forms, but just want to like, put this out there from like a 10,000 foot view that a lot of people like may not be very aware of, especially getting into rentals for the first time or owning your own business for the first time. But real high level, what's important to note here is, when it comes to being like a sole proprietor and starting your own business in any kind of industry, when we're looking at what types of additional tax forms do you have to file, there's really 3 main forms that we see out there. And this is not getting into like partnerships and other corporate structures and stuff, but just real basic high level. We have a Schedule F, appropriately named. The F gets for farming activities specifically. Then we have a Schedule E, which is specifically for rentals. Like the first page, nothing but rental activity in rental properties, right? And then there's Schedule C, and that is literally for everything else, right? So like just right off the bat, if we wanted to kind of show like some emphasis here on like why the specificity here is important and why it matters is if you consider the fact that literally the other 1,000 industries out there, they've got this one form of Schedule C that all those use. But then when it comes to rental specifically, we have a very specific form on your tax return for reporting those rentals. And we'll kind of get into why that's important. But if you're not a tax professional even, you can take a quick look at like a Schedule C and a Schedule E. And really, really quickly, you'll be able to just tell like how different they are. And real specifically, if you look at the expense line items that are listed on those forms, how drastically different a lot of them are. And you might ask like, well, why? Why is that? Why are there different forms? Why are the lines that they list out for expenses so different? Well, the majority of what's on the Schedule E there is very specific to something that you would see or that you would expect to have for a rental property. And we'll kind of get a little bit more, elaborate a little bit more into that with some practical examples and things though. But just from that high level overview, you can really quickly tell that when it comes to tracking the different types of expenses you have in your business, it's already readily apparent, even just on the face of the forms, that you want to be able to have good records and make sure that it's being reported correctly so that you're not raising a whole bunch of extra eyebrows and audit red flags.
Got it. So Schedule E is for the rental. Schedule C is like for businesses that get reported as a sole proprietor, or if you're operating as a single member LLC that's disregarded for tax purposes, like 1099 and NEC income, things like that. Okay, cool. All right. So why is bookkeeping important to Schedule E and to audit defense?
Yeah, yeah. So the first big thing here to also kind of, I would say, point out like on the Schedule E specifically, that even for a lot of business owners that have operated other types of businesses in the past that are not used to when it comes to your bookkeeping is with the Schedule E. Also, we have, and if you look again, real easily, you can see this if you look at it for even the non-tax pros, is there's a separate column for each one of the properties. So we not only have really specific expense categories that are listed out that are specific to rental activities, but we also have this specificity where we need to know what the total amount of those categories are for each property. And again, all this stuff is not just the IRS trying to make things like more complicated or whatnot to make your life more difficult or whatnot to make it harder to keep your records. There's usually a method behind the madness in most of these cases. And so to your question more specifically there, Tom, is that being able to identify, say, okay, how much in repairs or how much in cleaning expenses I have on property A versus property B versus property C is going to be important, because if you're looking at it through like an auditor's lens, looking at a tax return, what would you ideally, be looking for? Well, suspiciously high expenses, right? And so if you don't have that accurate bookkeeping, that accurate record keeping to be able to say, oh, I know that the cleaning expenses at, property A were 3,000 and property B was 0 and property C was 10,000, as opposed to just being all 13,000 being on one property, depending on everything else that's showing on that form, whether we're talking about how much rent did you collect compared to your expenses? All those are just subtle, not so subtle sometimes indicators that there's something amiss or there's something awry. Like, and for an example, if you had a long-term rental that was on your Schedule C and there is a way to designate it, that is also on the form that says it's a long-term rental essentially. If you had $15,000 in rental income, if I was like an auditor, if I see something like $10,000 in cleaning and maintenance expense on that property, it might be legit, right? Like maybe it was just a rough year, right, on that property. But again, looking at it through that lens, it's going to be something that you'd want to ask more questions about, right? And that's where we start to get into when you're in an audit scenario, those are the things that they're going to look for, right? Like those are the types of really, I don't want to say easy pickings, but it's the things that they're going to go, that seems way too high to me. There's too much expense or something in there. So they're going to ask for all that documentation behind it, whether that's asking for general ledger detail. Sometimes it's going all the way down into getting actual receipts and invoices themselves. But just right there on the surface, again, being able to properly identify your expenses, not just in the right types of expense categories so that it's not super suspicious, but also that you can break that out by property so that it's not getting erroneously lumped in too much or, swept into one specific property or one category.
Got it. So like the bookkeeping helps do a few different things, right? Sounds like, first of all, it makes sure that like it's actually being allocated to the right property. So no one property has too high of an expense kind of ratio, so to speak, like $10,000 when that's really too high. And that could trip up a red flag and cause the IRS to come asking questions. But also the bookkeeping system, if the IRS does, God forbid, come asking questions, you have all the detail, all the records, all the receipts, everything in there. So you can easily pull that up quite easily during an audit.
Exactly. Yeah. So, I mean, it's all about, good data in, good data out. But again, on the converse, if it's bad data in, bad data out, then it's going to potentially raise like additional red flags that you obviously like don't want to be throwing out there.
Got it. And I remember on another episode that we talked about audits recently, I think you had referenced that like the longer it takes you to produce certain records that the IRS requests, kind of the worse you are. Like you're kind of going like a downward slope of credibility. So I guess how important is it that someone, if they are, say the IRS audits somebody and they request the backup files for Schedule E, we want to see the line items, we want to see potentially the receipts for those to actually verify those, and it takes someone an extraordinary amount of time to pull that together. What kind of role does that play?
Yeah, it's definitely a huge hit to credibility there, right? And if again, looking at it from like the auditor's perspective, it makes a lot of sense. If they think that there is a broken link, right? Like there's a weak hole like in the armor that they can start peeling back, they're definitely going to dedicate more of their time like to trying to pry open that gap in the armor, so to speak. So when it takes you, exorbitant amounts of time, week, 2 week, 3 weeks or whatnot, to be able to just get back with, okay, here's support for my expenses, that is going to be a strong indicator there, just, for that, okay, there's probably not great credibility in here, so I should keep prying. As opposed to if you respond really quickly, so they say, okay, I want detail on all these expenses. You can say, no problem, I can get you that by the end of the day. That's phenomenal, right? Because that
Right.
very much conveys to the auditor that, okay, this person has all their stuff together. They clearly have a good set of financials. They can produce the things that I'm asking for quickly. And that signals to them that, okay, if I keep asking more questions and I keep asking for support for more categories of expenses or the next property, they'll look at it as kind of a losing battle and say, why would I bother if this isn't going to go anywhere? So, and it makes sense too, because I mean, it's a business, you know, you can say like IRS is, I mean, it's a government entity, right? But the IRS is a business like anything else. Like the auditor is going to look for the best ROI on their time, especially if they have a huge caseload piled up on their desk and they're thinking, okay, why go after, you know, this taxpayer that I might only recover $1,000 in taxes from? I'm going to go after that other one that seems to have really poor records or can't produce things, because I'm going to get the 30,000, the 40,000 from that person a lot more easily.
Makes a lot of sense. So bookkeeping just kind of is a decent defense to the sense that if you can continually produce really clean records for the IRS, it's a deterrent for them to keep digging further.
Right. It's an initial deterrent just right on the surface of just literally having what you would expect to see like on the form as far as not overstating expenses, or like you said, your expense ratios to rental income and things like that would be of the norm, right? For like industry norm or whatnot. So hopefully like an initial just, you know, helping to prevent an audit from even taking place in the first place. But unfortunately, if you are in that situation, the audit, it's going to be a huge deterrent for preventing them from, you know, being motivated to ask for a lot more questions. And the other part there too is it hopefully doesn't expand the audit. Like that's a potential where, again, if they're seeing that, okay, this taxpayer doesn't have very good documentation or they can't produce this, a lot of times, and not always, but a lot of times they initially will start with just looking at one tax year. And it's almost kind of like the idea of taking, you know, sampling. Well, if one tax year is super buttoned up, it's super clean, again, they're going to go, well, there's not a whole lot of point in me looking at a second tax year because we got absolutely nothing out of this taxpayer for the 1 year. It's probably because the next year they can expect is going to be all buttoned up as well. But on the converse, if they had a really great, again, ROI on their time, they found a whole lot of deductions they can disallow in one tax year, that gives them more of a, I don't want to say an excuse, but gives them more of that validity to say, okay, we want to look at a second or maybe even a third tax year if it's still within statute of limitations and things.
Right. That makes a lot of sense. What other issues can crop up as a result of not having bookkeeping in order when under audit or preventing an audit?
Yeah, you know, I would say the categories situation is pretty important, and I can give you like an example here too of things that are common that we see happen out there, and how this like crops up into like an audit scenario. And again, without getting into too much of the technicalities here, but just talking about the forms again themselves, something that I see fairly often, and I've seen this over the years, and seen this in these audits, is there is a specific line on the Schedule E there for cleaning and maintenance. Now, there's also a specific line that's just labeled repairs. And then we even have one for supplies. And it's really common for these to get confused or get muddled together. And they're definitely intentionally placed there for separate purposes, right? So for example, they're like, what you would not want to happen is if, say you have a short-term rental, and obviously we have cleaners coming in, say on a weekly basis. We want to make sure that that appropriately gets codified and lands on the cleaning and maintenance line item, right, on the tax return, as opposed to accidentally getting shuffled down into repairs, or vice versa. We don't want repairs getting muddied up into like cleaning and maintenance either. And again, because that context there is, if you're looking at it from that auditor's lens, if you have a short-term rental, having like a decently high line item for cleaning and maintenance does make a lot of sense. Whereas, you know, if that was say like a long-term rental, having a lot in cleaning and maintenance probably wouldn't make a whole lot of sense. And, you know, cleaning and maintenance is going to be something that should be for those like, what you can kind of think of as like recurring types of activities, like cleaner going in every week or something like that. Mm-hmm. Whereas like repairs are going to be for those bigger things. Something broke, we have to fix it. If I had to really kind of quickly delineate between those two, that's the dividing line almost with that one. So Basically, it's going to be important that you can really delineate those things out because, again, depending on what kind of property even that you have being reported there, it's going to raise a different kind of eyebrow if you have too much expenses in repairs versus cleaning. Another really good example of this that we see pretty often, and this, again, some of this just stems from, I don't want to say, should probably caveat this real quickly to say, like, if you're hearing this and you see these types of things in return, it's not necessarily like the preparer's fault. And I know we're putting a lot of this on like on you guys, the listeners here as taxpayers, is, to provide that good data. But if you're looking at it from that tax preparer's kind of perspective there too, something we see fairly often is if a taxpayer was to provide their tax professional with just a list of, say, like 150 expenses and says, here's all the contractors I used, or this is all the people that I paid, and that's the only piece of information that they have, well, tax preparer is not going to know. They're not going to know, was this professional fees? Was this, repairs? Was it cleaning and maintenance? And the categories that get muddied up a lot in those situations are, there's a specific one for advertising and a specific one for management fees, right? Again, those are very specific to rental activities. Advertising you can have in a lot of different businesses, I guess, but there is also a legal and professional fees category. Problem there is, again, if you're looking at it from the tax preparer's perspective, if you don't know, advertising is really specific. If you don't know for sure an expense is advertising, you're not going to put it in that bucket. Management fees is also super specific. So again, if you don't really know if it's management fees, probably not going to guess and put it in there. Whereas legal and professional fees, it sounds more like a catch-all, right? And that's almost kind of its fallacy. It's like there's definitely a place for legal and professional fees there. But what I see very often is a lot of stuff gets lumped into that legal and professional fees category that really probably should be broken out into some of these other categories like advertising or management fees. And the problem with that is it kind of looks almost like a big miscellaneous expense kind of category. And the issue there is that when you're trying to provide detail and break all that out for legal and professional fees, like, again, if you're looking at that as an auditor and you said, well, I wouldn't expect this taxpayer who has this, couple of long-term rentals, I wouldn't expect them to be engaging an attorney a lot, on a regular basis, right? Unless you're dealing with like things like evictions, for example, right? And then you definitely would have, that'd be a good example of someone to throw in legal and professional fees. But the fallacy or the issue that you could run into is, shoot, if that's the way that auditors looking at it, is that's the type of things they'd expect for legal fees. But you've got a bunch of this other stuff that accidentally kind of gets swept under the rug and pushed into that one category. Again, it's going to raise some eyebrows, be a bit of an audit red flag, and auditors probably going to want to sink their teeth into it. And maybe everything you have in there is well, at least documented so you could prove these are legitimate expenses. But again, if we're looking at this, we want to make this like as much of a deterrent as possible, right? We don't want to be throwing red flags, and we don't want them to be questioning the credibility there, because it, again, goes back to that, getting back to them quickly too. The more messy this is, right, the more they're going to want to try to sink their teeth into it, because they think that it's a higher likelihood that they'll find some things out of place.
So it sounds like it's first of all important to get your expenses properly categorized so that you reduce the chances of these expenses being, any of these line items on Schedule E, being too high for that category, and that could trip an audit in and of itself. But then also, if you're in the audit, in the thick of the audit, and the IRS looks at that and says, okay, your professional fees are rather high for this type of property, or the amount of revenue you have, or whatever the case may be, but they may very well be legitimate. And if you can quickly produce the support for that, you're putting yourself in a good position to defend that. So that's kind of the importance of it. With 2024 officially in the rearview mirror, now's the perfect time to start planning for how you're going to maximize your tax savings in 2025. With major tax changes looming under the new administration and IRS audits on the rise, navigating the tax code alone is now riskier than ever. Whether you're leveraging the short-term rental loophole, claiming the real estate professional status, utilizing passive losses, 1031 exchanges, or anything in between, our expert team of tax advisors at Hall CPA has your back. We'll help you uncover hidden opportunities and avoid costly mistakes that could put you at risk during an audit. With potentially tens of thousands of dollars of tax savings on the line, why wait? Visit www.therealestatecpa.com/podcast to request your free 30-minute discovery call today. Again, that's www.therealestatecpa.com/podcast for a free consultation. Let's help you ensure you keep more of what you earn in 2025. That's all for now, and we'll dive right back into today's episode. Before we go any further, I know we're talking about audit defense here today, not necessarily tax deductions, right? However, this kind of ties in because at the end of the day, the IRS is auditing your tax return, that's what they're auditing. So where does the line between tax preparer and bookkeeper, where's that divided? Because I think, this is not unique to our industry in real estate, but you see it in other industries as well, where sometimes clients or business owners or rental property owners, bookkeeper, tax preparer, accountant, these terms are thrown around rather maybe at some point synonymously, or there's some of the duties of these various roles are sometimes crossed, and people think when they're hiring a tax professional, they're also hiring a bookkeeper. When they're hiring an accountant, maybe they think they do everything. So kind of like, where's the line drawn between a bookkeeper and a tax accountant who's going to file your tax returns for you?
Yeah, that's a really good point to make there too. And it kind of, does tie into just kind of what the responsibility is, right, of your tax preparer and where that kind of line ends. And I think that it's definitely good to like trust, your professionals out there, right? Like your CPAs, your EAs, like that are doing these returns, but not putting a false sense of security in there is important as well. And because I've heard from a lot of clients over the years that when sometimes we highlight some of these issues, right, in the past tax returns, one of the things that we hear regularly is, well, I've used, this tax professional, CPA, EA, whoever, for many, many years. And I just assumed that if it was the information was incorrect, that they would have told me, right? Or something along those lines, or they should have mentioned that I was doing this incorrectly with my bookkeeping. Well, it's not the tax preparer's responsibility to audit the books, right? Their responsibility is to take the information that you give them, the financial information that you give them, and maybe that's coming directly from you, the taxpayer, or maybe you've got a bookkeeper who's helping to supply that information or whatnot. But the tax preparer's responsibility there is to simply take that financial information and report it correctly on the tax return. So they're putting everything into the right boxes. And now where we do have a little bit of additional responsibility there is that if something appears, exceptionally suspicious, we are required to inquire more, right? So if we see, an expense that got $10,000 in rental revenue and you got $100,000 in professional fees, yeah, we should be, asking, wait a minute, that seems really high to me, right? But in general, as long as everything is fairly like on the up and up, we're not going to go into the financials and go into the books to do a quote unquote, soft audit or whatnot to make sure that everything inside of the books is correct. Because that is the responsibility of the bookkeeper or the taxpayer if they don't have a bookkeeper or whatnot. And I will say, like, that's where it's important there too, to have those conversations. If you do have a bookkeeper that's, separate from like the firm you're using for your tax preparation, is talk to them more specifically and review the books and everything in detail. And that's where it can be kind of difficult, because if you don't feel comfortable doing that, or you don't understand accounting enough, you may not know the right types of questions to ask. And that's where I would definitely encourage you to, talk to an accountant who understands, the differences between like the different financial statements, like a profit and loss and a balance sheet, because again, good to trust the bookkeeper, but if you want to be able to, trust but verify, right? So you want to make sure that things like, okay, can you show me a balance sheet? Is there anything really suspicious looking on my balance sheet? But I'd say that's a good like delineation there between like the tax preparer's like responsibilities versus the bookkeeper.
Right. I think it's good to point out, because obviously for everybody tuning in, obviously I know this, but as like the host of this episode, I have to frame it like this. But yeah, so what it sounds like to me is like the tax preparer is typically not doing your bookkeeping.
Right. Very, very common.
Right. And to be clear to everybody kind of tuning in right now, if you think about it, like your tax preparer or the CPA firm that's preparing your tax returns could be doing your bookkeeping, but when you're engaging them for tax preparation services, bookkeeping is typically not included. It's a separate service, so you have to make sure you're engaged for them, because again, like Justin said, as a tax preparer, you're taking the information from the taxpayer and putting it into the tax return. And it's the taxpayer's responsibility to provide those books, right? Now, you might engage the CPA firm to also do your bookkeeping, right? But unless you're explicitly engaging them for that service, it's not always just going to be done.
Yep. Exactly.
Hey, real quick, if you've been a long-time listener to the show, then you know we give everything away for free. From how to use the real estate professional status and the short-term rental loophole to save tens of thousands of dollars on taxes, to upcoming tax changes, including the potential return of 100% bonus depreciation, we don't hold anything back. And the only way we're able to help more real estate investors is if you rate, review, and share the show. It just takes 15 seconds to leave a quick rating, review, or share with a friend who may find this information useful on their real estate journey. That's all for now. We'll dive right back into today's episode. What other items might we need to know about in regards to documentation and what we need to keep in the event of an audit, and how kind of this all kind of fits together?
Yeah, absolutely. So I want to, leading into documentation, we should talk about like two big items here. And one is going to be documentation for supporting your fair rental days is a big one. And this is going to vary depending on what type of property you have, right? If you have a commercial triple net lease, you've got a midterm rental, short-term rental, that sort of thing. You want to make sure that you have solid documentation on the actual days that are rented. I think this is an interesting one because I get questions very, very often about a myriad of topics that all hinge back to, does this get reported on my tax return? Or does this need to go on my return? Or Justin, are you just telling me this because I need it in the case of an audit, right? And there are a lot of stuff that you need to have in the case of an audit for audit defense that we don't necessarily have to have in order to prepare your tax return. I think that's like a really important delineation there too, because another surprise moment we hear from a lot of clients is that when we tell them, hey, I need you to make sure you have this documentation for XYZ, and they say, I've never done that before. My previous tax preparer never required that from me. And I would say, though, that's, again, not necessarily that they did something wrong, but it's just that they didn't give you the planning and the guidance maybe. But that's because a lot of the information that we need to be able to put things on the return doesn't necessarily require a ton of documentation, right? Whereas when we're talking about audit defense, you'll need a lot more documentation than just what you need when supplying something to your tax preparer. That being said, this is not one of those items. This is an item that we actually will put on the tax return, and it's the fair rental days. So if you have something like a short-term rental or midterm rental especially, you're going to want to make sure you have that solid documentation really for two reasons. One, like I said, we put the number of days that's rented is actually, there is a dedicated box on that form. And again, why do they put that on there? It's not just for the heck of it, right? There's a reason behind that. They want to see that number because that's going to feed into all their analysis and things. And obviously we know the short-term rentals, especially, it's important because we're going to want to be able to prove that average stay was 7 days or less, right? And we don't need to elaborate on that necessarily today. We've got a lot of podcast episodes on short-term rentals.
We're not going to dive into that today.
But again, so that's something that is going to be a critical piece of documentation. And it's something that I do see often very overlooked or just not tracked by taxpayers, by rental property owners. And unfortunately, what that results in a lot of times is a quote unquote default 365 being entered into that box. And that's something that, again, especially if you're a short-term rental owner, you're not going to want to have that quote unquote default 365 entered on there. If you're a short-term rental owner and you do rent it for 365 days a year, I would love to hire you and manage one for me because that would be amazing. But again, that's just a quick little potential like audit red flag there, right? If you have a short-term rental and that box says 365. So you definitely want to make sure you've got that retained. We've seen that question come up on almost every single short-term rental audit is actual proof of those bookings, right? So whether it's like an export from Airbnb, VRBO, some kind of log, you're going to want to have that. I've also, on the other side, like with the long-term rentals, they typically are going to ask for copies of the leases, right? So that's going to be, you want to actually retain your copies of signed leases. And remember, we want to keep these for at least 3 years, if not a little bit longer. Like typical statute of limitations is going to be 3 years from the date the tax return was filed, or 2 years from the date you pay the tax on the return. So usually it's going to be 3 years from when you filed if you're like paying your balances on time and stuff like that with your taxes. So definitely keep those long-term leases and records of your Airbnb, VRBO type bookings and stuff like that for that support. That's going to be pretty critical.
Absolutely. So what exactly, when it comes to, say, an auditor requests backup for a particular expense that someone has on their Schedule E or what have you, what is typically acceptable proof? Is a bank statement enough?
Yeah, so this is another often like surprise kind of shocker moment that I've seen in some of these audits too, is bank statements are not going to cut it. Like bank statements, credit card statements, even if you have a dedicated bank account for your rental properties, which I highly recommend, same thing, or a dedicated credit card. Some people even have one for every single property. However you want to do that, simply just retaining those bank statements are not going to be enough. They're going to want actual proof if that they see that money exiting the bank account. All that is proof that you paid something. They want to know what you actually paid for, because all the context around that is going to be important. They want to initially just want to make sure that was not actually some kind of personal expense, right? If that payment went to, a vendor and the name is something really vague, they're going to be thinking, how do I know that that's not a restaurant in that person's local area or a grocery store or something like that? They're going to want to see that you have an invoice, ideally, or a receipt of some kind. Because in the key details, there was a receipt, where it's like a Lowe's receipt, or if it's an invoice, because a contractor issued you an invoice, it's going to say what those items were that you paid for, or what those services were that you paid for. So the bank statement's only half of the equation. It's you paid, you've got proof of payment, maybe, but they want to know what that's actually going to be for, and you're only going to be able to get that from something like an invoice or a receipt. So if you're thinking it's not a big deal, I don't want to keep all these receipts, that's too much of a pain. Personally, I would say you definitely want to be able to produce those easily and not be relying simply just on bank statements. So that one's pretty critical. And that, I would say, is one of the biggest things that leads to deductions getting reversed or disallowed and increasing tax liability.
Okay, that's good to know. Now, before we kind of wrap up here, it's obviously really important to have all this documentation. What happens when you don't? What are the consequences when you cannot substantiate the deduction that you have and the IRS decides to say, you know what, we're going to disallow, for lack of a better word, we're going to disallow this deduction, and what happens at that point?
Yeah, that's huge. If the question that gets posed to me a lot is well, if I just don't have those, what's the risk? What am I facing? Okay, I lose the $1,000 deduction or something, and okay, if my tax bracket's 35%, so I'm going to lose $350 in tax savings, right? Mm-hmm. It's not just that, though, unfortunately, because there's always potential for penalties and interest to get tacked on. And there's a myriad of different types of penalties that they can assess. And most commonly, it's going to be something related to an underpayment type of penalty. And those can be in the single digit percentages, depending on when the audit's happening, when they're assessing. But the bigger ones that come into play is that, and again, this is why auditors are going to go after those bigger fish when they're looking for big deductions to disallow, is because if your tax liability, if they determine that your tax liability got understated by more than 10%, and they can do that by say, okay, we found a whole bunch of deductions we're going to disallow, so that's increasing your taxable income, and therefore we can now say that, okay, this tax liability was understated by more than 10%, they can tack on an extra 20% penalty on that underpayment. So
Ouch.
If you're thinking about, okay, if I have $10,000 of deductions disallowed, well, okay, they're going to claw that back, and it's going to be $3,500 in taxes. Well, no, it's there. Yeah, $3,500 in taxes, but if it's big enough, they can tack on that extra 20%, an extra $2,000, right? So that's the additional out-of-pocket expense is pretty severe. And on top of that, they're going to tack on interest on top of that as well. And when they charge interest, it's not just on the amount of tax that you underpaid. It's also on the penalty. They're allowed to charge interest on penalties until you get everything paid off. So, this and there are some additional penalties that are even higher than that if they believe that this was intentional. So hopefully you're not having intentional disregard for the tax code or whatnot, that they can hit you with that one, but that can ratchet it up even higher and potentially add on another 20% on top of there. So when it's all said and done, losing the deductions is a big deal. But it's an even bigger deal if it's getting up to that point where it's substantial, what they would consider substantial, because that could be, in some cases, we've seen them try to levy that, and it's tens of thousands of dollars, depending on how large the disallowances are.
Right. So what I'm hearing today is that there can be consequences to getting deductions clawed back, and they can be painful. But it's not really that an audit in and of itself is the thing to fear, although of course we don't want to get audited, obviously, but more so it's being unprepared for the audit when it does come. And part of being prepared is having good bookkeeping in order, and also keeping other documentation to support the tax strategies you may be implementing on your tax return. Would you say it's a fair assessment?
Yeah, absolutely. And you kind of hit on that last point there too. What I want to make is just the fact that the stress that it puts you through is crazy high. But if you're in that situation where you've got a really good bookkeeping system in place, you're using something like QuickBooks or Wave or what have you, it's just going to drastically reduce your stress load, right? Of just knowing like, okay, whatever they asked me for, I got all my documentation. It's not going to be a big deal. Justin can go and pull all that stuff out of QBO for me or whatever in an audit situation. So like, not only is it going to be an initial deterrent, one, to hopefully make an audit not even happen, but if you are in an audit situation, because that credibility is going to be higher, an auditor is going to go away a lot faster, you're literally just going to get it done more quickly, which just means it's out of your hair. And also, while it is ongoing, it's going to be much more stress-free, right? If you can know that no matter what kind of thing they're going to ask me for, I have all the documentation for it.
Right. So documentation, being organized, everything you've set up is critical to the success in the event of an audit. So if you are looking for a CPA firm that does understand real estate, personal, and business tax strategies, we help investors on a daily basis set up tax strategies to not only maximize tax savings, but also set you up with the documentation that you do need to protect yourself in the event of an audit, things like time logs, tracking fair rental days, things of that nature. That is critical. So we set you up from that from a tax strategy perspective, but also from a bookkeeping perspective. If you do want to work with us on bookkeeping, we can set up your bookkeeping. We can help run it on a regular basis so that your books are clean, organized, and ready to go, not only to help you maximize deductions during tax time, but also in the event of an audit, you have everything nice and organized in order to defend yourself. And on top of that, we can help you through controller and CFO level services better understand your financials so that you can make better decisions, make getting loans easier. We do help clients with all this. So if you are interested in looking for a firm that can help you with this, I invite you to schedule a free discovery call. The link is in the show notes to this episode. And want to thank you, Justin, again for coming on the show today, letting us know what we need to do to defend ourselves in the event of an audit. Is there any final words before we wrap up?
Again, appreciate it. Thanks for having me on. And we'd love to help make sure that you have all that audit defense armor on as much as possible, and hopefully keep you stress-free in any of those types of events. It's always easier. I would say don't wait on this stuff either. I guess as a final thought, it's a way easier to do this periodically throughout the year and in the moment, as opposed to trying to do it either during tax season or worst case scenario, if you're trying to do it during an audit, it'd be it's that much more difficult when you're looking further back into the past. So get on it now. It's easy once you get cranking out on a monthly basis, or have somebody like our team helping you with the bookkeeping on a monthly basis. Much lighter lift.
Oh, for sure. And look, this is not audit related. I'm not being audited, but just to give you guys a personal anecdote, I'm wrapping up my 2024 tax returns, and I'm going back right now and figuring all my details. And like, yeah, I have to remember all this stuff, make sure everything's properly documented. And I can tell you right now, thank God that I have everything cleanly written and organized. Yeah. Otherwise, I'd be searching and digging through all these emails. And like, what I'm trying to share is that from personal experience, life is so much easier when you have everything organized versus when you don't. So organization, it seems like not the funnest part of business, but it goes a long way in, like Justin said, keeping you stress-free, and then like also in the event of an audit to save you as well. So again, I want to thank everybody for tuning in. We'll be back next week. And until then, happy investing.